Hello, Happy New Year everyone. I'm back in Hart Family Accountancy headquarters, aka the Home Office. Just to follow up on the last video from before Christmas about buy-to-let property and the solutions for that. So basically, in the last video I covered off how the rules are particularly unfair for if you own a property personally and you're a higher rate taxpayer, how you can end up paying tax without making any profit, which is just crazy to me. Like, you can be out of pocket every year because you own a buy-to-let property, which is just unfair. The rules shouldn't be like that. Now, one of the things you can do is you could buy that property originally is the most efficient way of doing it. So when you originally buy the property, buy it in a limited company. Potentially, if you know you're going to be a higher rate taxpayer, you've got a job, PAYE, or you have a good business, self-employed, and you're going to be earning above that £50,000 mark, then you can basically own that property in a company, and you would generally pay 19% corporation tax on those profits. It works slightly differently. So if you have two companies, two separate companies, which is generally how you need to own it. So if you have your own limited company that's trading, you might be contracting, you would generally need another limited company to own the property if you're going to get a mortgage on it. So mortgage providers will want that property in its own standalone company. But that means you own two companies, and from HMRC's perspective, what they do is you've got a £50,000 lower profits limit for corporation tax. So the first 50 grand you're paying 19% corporation tax on. Anything above that is 26.5. But if you own two companies, that 50 grand is halved between the two companies exactly. So even if your trading company is making more than 50 grand profit, that's going to cost you like almost 2 grand a year in extra corporation tax, even if the other company doesn't generate more than like 5 grand rental income, say, from one property. So you need to be careful. It needs to be planned out properly. I do like individual scenarios, so on a case-by-case basis, depending on what people are doing with the property. Are they renting out long term? Are they wanting to pay down the mortgage? Are they wanting to buy another property? Are they wanting to maybe sell it in a couple of years? Like, all these factors need to be handled in. And the other thing is that mortgage providers will often charge a higher interest rate for a mortgage in a limited company because they see it as higher risk. So if there's a shortfall on the mortgage, they can't chase an individual for the shortfall if the property market did go south. So yeah, it needs to be considered on a case-by-case basis. Thanks for watching. Toodle pips.